Welcome to the deep dive. Right now, the U.S. stock market is, well, it's really navigating a treacherous environment. We're seeing this powerful collision of opposing forces, and it's all happening incredibly fast, almost on a 24-hour horizon. Our mission today. To give you a shortcut to understanding what's going on, leading into this week, there was this feeling, sort of a cautious optimism, right? The belief is that, okay, inflation is moderating, and that would give the Federal Reserve the justification it needed for maybe a dovish pivot later in 2025.
That was definitely the hope, the dream scenario, really.
Exactly, hinting at smoother sailing. But, well, we've seen how quickly that clarity can just evaporate when new information hits. So today we're going to unpack the latest data, the reports, try to untangle these, frankly, conflicting signals, and extract the most important insights. The goal is to give you a clearer view of what's happening, what it means for you, and especially for stock investing right now. Let's dive in. Okay, let's start with what seems like a really positive signal just a few days ago. The May Consumer Price Index, the CPI report, that came out June 11th. And the data was, well, unequivocally softer than economists had forecast. It really seemed to reinforce those disinflationary trends we were looking for. What specifically stood out there?
Well, the numbers were pretty compelling. You look at the headline CPI, it rose just 2.4% year over year. That was below the 2.5% consensus. And maybe even more importantly, core CPI, stripping out food and energy, that also undershot expectations, came in at 2.8% annually versus the 2.9% forecast.
And monthly core was slow, too.
Yeah, barely moved, just 0.1% month over month, a real slowdown from the 0.3% people expected. Now, falling energy prices helped, down 3.5% year over year, but we still have that sticky shelter inflation up 3.9% year over year. That's still a concern. But taken in isolation, this data really strongly reinforced the case for future rate cuts. It was exactly what the doves wanted.
Okay, so on one hand, you got inflation cooling, seems like good news for rates, but then bam. Just this week, a really dramatic counter signal emerges. What hit the wire?
Precisely. A significant escalation in the Middle East. We saw reports June 17th, 18th, detailing this hardening stance in the Israel-Iran conflict. You heard President Trump dismissing ceasefire hopes, talking about needing, quote, a real end, and then Israel issuing evacuation orders for parts of Tehran.
Wow, okay.
And the market reaction, immediate, classic risk-off move. U.S. equity futures tumbled. Dow, S&P, Nasdaq 100, all pointing down 0.6% to 0.8%.
And oil
spiked, as you'd expect. Brent crude climbed above $74 a barrel on those supply disruption fears.
Yeah.
That's the market reacting instantly to potential global supply issues.
And this is where it gets really interesting, right? This complex feedback loop. You've got the soft CPI data, which is fundamentally disinflationary.
Right, cooling prices.
But then the Middle East conflict is inherently inflationary, mainly through that energy channel.
Exactly.
So the geopolitical event just directly neutralizes the positive feeling from the economic data. It's like good news immediately canceled out by bad news.
Pretty much. A headwind meets a tailwind head on.
So how does this mess things up for the Federal Reserve? Their meeting is coming right up.
Oh, it creates a real challenge, especially for the FOMC meeting on June 18th. Now, look, the market's pricing in basically a 99.9% chance they hold rates steady, right? In that 4.25% to 4.50% range. That's almost a given.
Right. So the action isn't the rate decision itself.
Exactly. The focus is squarely on the forward guidance. What do they say? Within the dot plot, there's summary of economic projections. And what does Chair Powell say in the press conference? That's what matters, because they can't just deliver a simple dovish message anymore about cooling inflation. They have to acknowledge these new upside risks to inflation coming from, geopolitically driven energy prices.
So the tone shifts.
It has to. It shifts the probability away from purely dovish to something more cautious, more data-dependent, really emphasizing the uncertainty. And that could push back any potential rate cuts.
Okay, and based on this new, more complex picture, our sources laid out a few potential scenarios for the next 24 hours or so. Just shows how uncertain things are. Can you walk us through those?
Sure. So roughly, there's maybe a 40% probability of what we'd call risk-off escalation. That's where geopolitical news gets worse, and the Fed sounds hawkishly cautious, pushing that higher for longer narrative.
Okay, scenario one.
Then maybe a 35% chance of a volatile stalemate. Tensions stay high, but don't really escalate further, and the Fed gives kind of neutral statement. Market stays choppy, range-bound.
Makes sense.
And finally, only about a 25% chance of a dovish de-escalation. That would be some unexpected good news, maybe tensions ease, Fed sounds surprisingly soft. That would likely spark a sharp rally.
Got it. And how did the market react immediately to this shift in risk?
Well, the rotation was pretty clear. The energy sector, you look at the XLE ETF, it was the only gainer in the last session,
Yeah.
up 1.74%.
Directly reflecting the oil price jump.
Absolutely. That conflict premium being priced right in. And conversely, sectors that are sensitive to economic stability, interest rates, they lag badly. Financials, XLF, down over 2%. Technology, XLK, dropped 1.4%. Tells you where the money's flowing.
Exactly. It shows where the market is hedging its bets right now. And importantly, the S&P 500 is testing that critical 6,000 level. That's a big psychological and technical point. If it breaks below that, well, that could definitely invite more selling. Which brings us to the really crucial question, right? How do you, the investor, navigate this kind of conflicting macro narrative? When the big picture is so messy, our sources are saying stock selection has to be anchored in really specific, potent catalysts, things that can create idiosyncratic price action.
Yeah, idiosyncratic just means moves based on the company's own story, right?
Exactly. It's stocks that can move on their own merit, even if the broader market is just, churning or falling. How do we find those? Any examples stand out?
You're absolutely right. It's about finding companies with a clear, unique driver, something that lets them defy the broader tide. And Jabil Inc., ticker JBL, is a really prime example here. It's a large cap play, and it provides concrete, present-day validation for the whole AI theme. It moves beyond just the hype.
Okay, how so?
Their Q3 earnings report just came out June 17th. It was a significant beat. Core EPS, $2.55 versus maybe $2.28 consensus, and they raised their full-year guidance.
Strong numbers.
Very strong. And crucially, management explicitly pointed to strength in cloud and data center infrastructure. So this isn't just generic tech growth. It's direct, tangible proof that the AI build-out is actually happening now in the physical infrastructure layer. It shows the hype is turning into real revenue for key suppliers.
And the market liked it.
Oh, yeah. Stock surged 8.8% on the news. It underscores this as a fresh, fundamentally driven rally. Plus, you look at its ownership over 94% institutional, and short interest is low, just 4%. Institutions are bought in, and not many are betting against it. It feels fundamentally sound.
Okay, so JBL gives us that tangible look at the AI build-out reality. Now, what about NVDA, the undisputed leader of the AI revolution, the ultimate market bellwether? What happens to a stock like that with such incredible long-term strength when these immediate conflicting forces hit? Is its leadership enough, or is it actually more vulnerable in this kind of risk-off moment?
NVDA. That's where you see a really crucial conflict play out. On one side, yes, exceptional long-term fundamentals, clear market leadership, no question. But on the other side, you have this immediate bearish macro environment driven by the geopolitical risk we talked about.
Right.
NVDA has this enormous open interest. Over 23 million options contracts outstanding.
Wow, what does that signify?
Well, open interest is just the total number of option contracts, bets on the future price that haven't been settled. I mean, there's a massive amount of capital tied up in speculating on where NVDA goes next.
Okay.
It's a real battleground.
Okay.
And then you add in the fact that there's been significant, pretty consistent insider selling. Directors, the CEO, they've been selling shares. That's a classic conflict signal, isn't it?
Yeah.
Why sell if it's all clear skies ahead?
Definitely raises an eyebrow.
So our AI-driven Monte Carlo simulations for NVDA, which factor in its high volatility, they suggest a wide probability distribution with what we call fat tails.
Fat tails?
Yeah.
Meaning?
It's a difficult thing. Basically, it means our simulations show a much higher chance of extreme price moves both up and down than you'd normally expect. So the potential for outsized moves in either direction is elevated right now. Makes it very unpredictable short term.
So what's the primary thesis then?
Our primary thesis here leans towards short-term bearish, or let's say corrective price action. With high confidence, actually. Look, NVDA is an amazing long-term story, but this overarching macro risk-off mood, it's very likely to weigh heavily on high beta market leaders like NVIDIA.
High beta meaning it moves more than the market.
Exactly. So in a downturn, it tends to feel more pain. The macro environment likely trumps the company's specifics in the immediate term here.
Okay, let's shift gears to mid-caps. Carpenter Technologies, CRS, this one's described as an industrial strength play, specialty metals for aerospace, defense. Seems like it should benefit from both long-term trends and maybe even this heightened geopolitical tension, right? What's the signal here?
Yeah, CRS is interesting. The conflict here is quite stark. On one hand, you have just overwhelming bullish price momentum. The stock's up 146% in the past year. Some analysts have a strong buy on it. You see strong institutional buying too.
Sounds pretty bullish.
It does, but This is directly countered by some significant high-level insider selling,
Mm-hmm.
including one director who sold, get this, 100% of their holdings.
100%. Wow. That's a red flag.
It's a significant red flag. You can't just ignore that. Still, despite that selling, the dominant signal probably still leans towards bullish continuation, mainly because of that powerful momentum. And also, it has high short interest over 11% of its float.
Meaning lots of bets against it.
Right, and that creates the potential for a short squeeze. If the stock keeps rising unexpectedly, those betting against it might be forced to buy back shares, pushing the price even higher.
Oh, okay.
But because of that insider selling, our confidence level here is only medium. There's a definite conflict in the data. Got it. Next up, Shake Shack, S-H-Shake. We're looking at this one as a kind of consumer health proxy. Fast casual dining. What's the read here?
Shake Shack, yeah. It has very high short interest, over 13% of its float. So as we just discussed, that means a lot of investors are betting its price will fall. There's a strong bearish consensus out there.
You okay?
You add in some recent analyst downgrades and its, inherent vulnerability to any worsening in the economic outlook. It makes it a pretty compelling candidate for a bearish setup. We have high confidence on this one.
Because if consumers get nervous...
Exactly. If consumers pull back on discretionary spending, maybe because gas prices are up from this conflict, or just general uncertainty, a place like Shake Shack could be quite sensitive. It's a good barometer for the consumer's mood, really.
And finally, Verve Therapeutics, VERV, the speculative event-driven play. This one definitely had a wild ride this week.
Oh, absolutely wild. So VERV had this definitive merger agreement announced on June 17th. Eli Lilly announced they intend to acquire Verve for $10.50 per share, all cash.
M&A news always move stocks, especially this one, because that news acted as the catalyst for a truly catastrophic short squeeze. VERV had just astronomical short interest, over 30% of its float. A huge number of investors were betting heavily against it.
30%, okay.
So when that acquisition news hit, all those short sellers were absolutely forced to buy back shares to close out their losing positions. And that just caused the stock to explode upwards, over 80%.
Wow. Painful for the shorts.
Extremely.
Yeah.
But for anyone looking at it now, our confidence level is low. The thesis is basically neutral volatile because that primary squeeze is likely over. The big explosive move has happened. Now, the price action is probably going to be unpredictable as it trades around that $10.50 offer price. The main opportunity from the squeeze itself seems to have passed.
Okay, so we've seen the macro clash. We've looked at specific stocks with their own catalysts and conflicts. What does this all mean for you, the listener?
It feels crucial now to look beyond just that immediate price jump or drop and understand the second-order implications, right, for more sophisticated positioning.
Yeah, seeing the ripple effects, getting to those aha moments.
Exactly. If we connect this to the bigger picture, these second-order effects are where the really valuable insights often lie. First, take the VERV M&A deal. It does more than just affect VERV. It effectively re-rates the entire gene editing sector.
How so?
Eli Lilly, putting down serious cash for Verve, acts as this major validation for gene editing technology overall. It signals huge confidence from a pharma giant. So the aha moment here is that this could easily trigger sympathy rallies in related stocks, or maybe draw more institutional money into the broader gene editing space. Think ETFs like XBI. Other firms in that field might suddenly look like more credible acquisition targets themselves. It fundamentally shifts how the whole sector might be valued. That's a big deal.
Right. Lilly's move lifts the tide for similar boats.
Precisely. Second aha moment, Jabil's AI strength. We talked about their great earnings validating the AI build-out.
Yeah, tangible proof.
But think about the flip side. For Jabil to be doing so well, selling cloud and data center gear, it means its customers, the big cloud providers, the enterprise AI developers, Google, Amazon, Microsoft, they must be incurring massive capital expenditures to buy all that hardware.
Huge spending on their part.
Massive. And that intense spending could lead to significant margin pressure for those tech giants in the coming quarters, unless they can quickly and effectively monetize their AI investments to offset those costs. So Jabil's gain could actually signal future pain, or at least pressure, for some of his biggest customers. It's an interesting push-pull.
That's a great point. The cost side of the AI boom.
And third, this geopolitical shock creates a fascinating trap around quality versus value investing.
Okay, explain that.
Well, the conflict drove that classic rotation into energy stocks, right? Energy is traditionally seen as a value sector, often a defensive play in inflationary times.
Right.
However, risk-off environments typically favor quality stocks, companies with strong balance sheets, stable earnings, low debt, regardless of what sector they're in.
So there's a conflict there too.
Exactly. It creates this strategic paradox. The simple first-level reaction is buy energy. But a more nuanced approach might favor companies that combine both characteristics, like maybe major integrated oil companies that also have really strong balance sheets. The aha here isn't just picking a sector based on the headline, it's about reevaluating what safety actually means in this specific volatile market. It means looking for financial robustness within the currently favored sectors, not just chasing the sector itself.
So who's most vulnerable then?
Probably companies with high leverage, lots of debt, in cyclical sectors outside of energy and defense, those could be caught in the crossfire.
Okay, this is incredibly helpful for framing things. So based on everything, the probabilities, the risk reward, the catalysts, our analysis pointed to a few top-ranked trade setups right now. First, that short-term bearish view on NVDA seems to align perfectly with the dominant macro theme, that geopolitical risk-off, high probability, around 70%, and a potentially excellent risk reward. It's a high flyer facing headwinds. Second, the bullish stance on JBL. That's supported by that powerful, fresh fundamental catalyst. The earnings beat, the AI validation, gives it that idiosyncratic strength to maybe defy the market. Also, high probability, 70%, solid risk reward. And third, the bearish outlook on Shake. Benefits from that strong bearish consensus, the high short interest, the analyst downgrades. And it aligns with potential weakness in consumer sentiment, offers a high probability, maybe 65%, and strong risk reward as that consumer proxy.
And it's really crucial to understand this kind of insight doesn't come from just looking at one thing. It comes from acknowledging these contradictions, resolving them where possible between different data sets, and crucially, building on the most recent high-impact information we have. Like our thesis on the AI momentum theme is updated now. It shows tangible revenue and profit in data center infrastructure, not just chips. That offers resilience, maybe new opportunities, and our Fed policy outlook. As we said, it shifted from purely dovish to cautiously neutral because of this new geopolitical inflation risk. And that directly informs why we might be short-term bearish on the big indices or on high beta names like NVDA. It's all connected. It's all about adapting to the latest signals.
We've definitely covered a lot of ground today, navigating a really complex landscape. It's amazing how quickly a seemingly clear market view can get completely reshaped by unexpected events, isn't it?
Absolutely. The ground can shift under your feet very fast.
And this deep dive really highlights the value of, well, dissecting all this complex information, understanding the collision of forces at play. It gives you not just facts, but hopefully a better framework for making sense of it all and maybe shaping your own investment strategy.
You know, it really raises an important question, though, doesn't it? In a market that evolves this rapidly, how constantly do investors need to reassess even their most deeply held assumptions? Assumptions about fundamentals versus these sudden macro shocks. And what does this constant dynamic interplay mean for the whole concept of long-term investing when the short-term picture can just change so dramatically, so quickly? It's certainly something to think about.
Definitely a lot to think about for the fastest, most frequent updates, and really to stay informed and hopefully ahead in this incredibly dynamic market environment. Make sure you subscribe to The Deep Dive. Thanks for joining us today.